Well, as promised, let's talk about the stock of the day perhaps, and that's Tata Motors, because the Q3 numbers missed the mark on all parameters as Jaguar Land Rover reported a loss for the third straight quarter. Now, JLR posted a one-time loss of 28,000 crore rupees due to asset impairment. Now, to put it in perspective, the asset impairment is almost half of the Tata Motors' current market capitalization. And talking about market capitalization, look at the Tata Motor ADR on your screen. Now, that one ended 10% lower in trade yesterday. It remains to be seen of how the Tata Motors stock reacts in the Indian market today, because do remember the brokerages have given a thumbs down to the numbers. A lot of them have actually downgraded the stock or at least cut the target price. So the stock definitely will be in focus today. So let's go across to Sonia Shenoy now, who will tell us what are the key highlights of the numbers. Sonia, good morning. A shocker of a number.
It was a shocker for Tata Motors this time around. Hugely negative numbers, a big consolidated loss of 26,900 crores because of a one-time loss of 27,000 crores that they had to incur on account of impairment of JLR's assets. But even if you strip that off, the Jaguar Land Rover core operational performance has weakened substantially. It's the third consecutive quarter of losses for JLR. In fact, JLR has reported a net loss of 3.1 billion pounds this time around, much higher than what they saw last quarter. But the biggest disappointment really lies on the margin front. 7.3% margins is what Jaguar Land Rover reported, much below street expectations of around 11% and a 360 basis points fall on a year-on-year basis. The management blamed it on weakness in China as well as the destocking impact. Even the standalone numbers were nothing to talk about. In fact, standalone revenues grew just 1.5% year-on-year to 16,200 odd crores, and it recorded a 600 crore profit. However, the standalone business is very small. The big disappointment really comes from Jaguar Land Rover. On that context, the management did mention that the demand situation continues to be quite muted and things could continue to be challenging despite the cost control efforts that they have undertaken.
Okay, so the commentary from the management was weak. In fact, on that note, let's hear out what PB Balaji, the Group CFO of Tata Motors, had to say on JLN's performance this quarter.
Jaguar Land Rover, the performance was impacted by corrective actions that we have taken in China, the weak market conditions there, and the production shutdown there. The revenue at 6.2 billion was down 1.4%, and PAT at minus 3.1 billion pounds basically got impacted by the corrective actions that we did on taking an impairment on our assets there. Taken a one-time exceptional charge for asset impairment. This reduces the growth and depreciation and amortization rates by almost 300 million per annum going forward. So it's a right step that we have taken in terms of reducing our costs, improving our break-evens, and as well as ensuring our competitiveness.
Okay, so that was about Tata Motors, but more numbers are expected from the auto space today. So let's go back to Sonia, because we'll check what to expect from M&M this time. Sonia, over to you.
Well, for Mahindra & Mahindra, the stock is down 30% in the last 6 months. This is because the management had guided for meeting just the lower end of their tractor guidance of 12 to 14% revenue growth by the end of the year. After scaling down their tractor guidance, the stock was under pressure, but the auto segment margins have also been under pressure. It's fallen from 10.6% in Q4 all the way down to 7.8% in Q2, also because of additional launch costs on account of the new Marazzo. Now, for this quarter, we are expecting a reasonable performance because tractor growth has been good. 11% overall volume growth is what we've seen. Tractor volumes have gone up by 11%, although the passenger vehicle volumes have been a bit muted. All of this will lead to a revenue growth of 12.5% for Mahindra & Mahindra. Margins will be largely stable despite higher discounts. The margins have not been impacted much because the management has passed on raw material prices in terms of price increases. So they'll hold on to margins at about 14.5%, and profit growth of 11.6% is what we're expecting. The most important, two key important points to watch out for from the management. One, whether they still stick to the 12 to 14% volume guidance for the tractor segment for the full year. And two, whether margins in the auto segment will continue to dwindle from that double-digit mark that they saw 3 quarters ago, now almost at 7.5%. If it falls further, that's something the street won't like.
Okay, so that was about the auto space.